Welcome to the Tokenized Economy. Today, we're diving into a really fascinating question. How does the SEC actually think about tokenized securities? In our last explainer, we kind of painted the broad strokes of the US approach. But now, we're going to go a level deeper and unpack a pretty fundamental shift that's happening as we speak.
So, what is really going on in a regulator's mind when they look at a tokenized security? You might think they're immediately dazzled or maybe worried by all the fancy new tech, right? The blockchain, the smart contracts. But is that where their attention really is? Or are they looking at something else entirely? Well, let's find out.
And that actually brings us to our first major point, and it's a big one. It's this core misconception that honestly trips a lot of people up. So many folks think this whole conversation is about the technology. But the reality? For regulators, the conversation always starts with structure.
Okay, so you can see the contrast right here. The common misconception is that regulators are laser-focused on the token itself, the little piece of code. But the reality is, they're looking straight through the token. They want to know what it represents, and this is so important, how the entire system that it's a part of actually operates.
Right, so because the focus is on structure, we're starting to see three pretty distinct models take shape out there in the market. Let's break down what they are.
Okay, so first up, you've got issuer-native tokenization. Think of this as the asset literally being born on the blockchain. Then there are the intermediated or custodial models. These are basically digital wrappers. You take a traditional asset, a custodian holds it, and you create a token that represents it. And third, you have synthetic exposures, which really just act like derivatives. And as you can probably guess, each one of these setups comes with a totally different set of regulatory questions and implications.
So, you might be wondering, how do we know this is really how the SEC is thinking? Well, we actually got a huge clue from some pretty recent staff guidance. Now, this wasn't some big, flashy, headline-grabbing announcement. It was way more subtle, but man, it revealed a really crucial shift in how they see the world.
So the guidance was focused on this term, covered user interfaces. What does that even mean? Well, just think of it as the software layer you interact with. The dashboard, the app on your phone. It's what takes your command, like, hey, I want to buy one tokenized share of this thing, and translates that into code the blockchain can actually understand and execute. And usually this happens through a self-custodial wallet that you control.
So, okay, by looking at something as simple as a user interface, what did the SEC actually reveal about its bigger picture thinking? What was the real bombshell hiding in this pretty technical-sounding clarification? And here it is. This is the absolute key insight. The SEC staff basically said, hey, just because you build a piece of software that lets people interact with a tokenized security, that doesn't automatically make you an intermediary. Now let me tell you, that is a huge deal. It's a clear signal that they're moving away from these old blanket assumptions.
And they didn't just leave it there. They got really specific. They said an interface might not be a broker-dealer if it's just, well, a passive tool. If it's not out there actively soliciting transactions, if it's not giving you investment advice, and, critically, if it doesn't control the execution of your trade. If it's just a neutral gateway for you to do your thing, then it's in a completely different category.
And, this isn't just some minor little tweak in the rules. This really signals a fundamental paradigm shift. It's about how regulators are approaching this whole new market structure. It's a move away from focusing on what you call something to what that something actually does.
Think about it this way. The old approach was all about entities. A regulator would see a company involved with securities, and their first instinct would be to try and jam it into a pre-existing box, right? Are you a broker? Are you an exchange? But the new approach is all about function. Now they're asking a much smarter question. What specific financial function is this company or this piece of software actually performing? To put it as simply as possible, what you do matters way, way more than what you're called. It's your actions within the system, not your fancy job title or your company's slick marketing page, that are going to determine your regulatory obligations. Full stop. Okay, so let's tie this all back to those three models we talked about earlier. How does this new function-based thinking affect them? Well, for the issuer-native models, it probably means a much clearer mapping to traditional rules. The intermediated models, they're still likely going to be looked at through that existing broker-dealer lens. But the synthetic models, yeah, they're going to face the most scrutiny, and they'll probably be treated as their own separate thing, like derivatives. So the deeper shift here, the really big idea, is that the SEC isn't just taking the tokenization label at face value anymore. It's like they're taking the whole thing apart, piece by piece, like a mechanic deconstructing an engine. They're breaking it down into its core functions just to see who's doing what. And they're basically going down a checklist of functional questions. Okay, number one, who's actually performing the execution?
Number 2, who has custody or control of the assets? And number 3, who is directly interacting with investors? The answer to each of those questions is what's going to define the regulatory duties for every single participant in the system.
All right, so let's zoom out. What does all of this actually mean for the future of financial markets? Well, this evolution in regulatory thinking, it's really pushing us toward a much more precise and, maybe even a more efficient market structure.
And here's a really critical point to get your head around. A lot of people think tokenization magically makes all the old financial roles like execution, custody, clearing just disappear. It doesn't. Not at all. What it does is it redistributes those roles. It spreads them out across smart contracts, software interfaces, custodians, the whole shebang.
And this brings us to our final and honestly probably the most important takeaway from all of this. There's this popular narrative out there that tokenization and regulation are at war with each other, but that completely misses the point. The reality is that this technology is forcing regulation to get smarter, to become more precise. It's forcing to move away from lazy labels toward a much deeper, function-by-function understanding of how finance actually works.
So, coming up next, we're going to build on this foundation. We'll move from just interpreting the rules to looking at active policymaking. We're going to dive into legislative efforts like the Clarity Act and see what they could mean for the future of all of this.
Hey, thanks so much for tuning in. Be sure to subscribe for more short explainers on blockchain, tokenization, and the financial markets. And definitely let us know in the comments if there are any questions you have or topics you want us to cover next.